Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 161 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Today, we are going to be talking about your investing life and buying the dips. And we're going to dig into what it means to buy the dips, what it looks like to buy the dips responsibly, and how you can incorporate this idea of buying the dips in the market or in a specific stock into your investing strategy. And so we'll dig into all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, then be sure to subscribe and review the podcast on either one of those platforms. That would be greatly appreciated. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things that I'm talking about in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan that is specific to you and your family situation and keep you accountable to that plan over the long term, then I can help you do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and then you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So it is important from time to time to reevaluate what your investing strategy is. And not just what you're investing in, what your asset allocation is, what kind of returns you're expecting, not just those things, right? But also how you are actually putting money into whatever you're investing, how you are choosing to put money into whatever you're investing in, and why you are choosing to do so. Now, for the vast majority of Americans, for the vast majority of individuals who invest, what they do is a dollar cost averaging type of idea. And this is nothing more than an individual taking a certain dollar amount, right, or even a certain set percentage, and investing that into a group of investments over and over and over again, regardless of the price of those investments. And this has proven to be a very beneficial way of doing things because you can average out your risk, right? Because if you are continuously buying regardless of the price of the investment, then you're likely to buy when the price is high and when the price is low, and you're likely to get some average price. Therefore, you are likely to get some average return as to what that investment would have made over time. And so the dollar cost averaging idea is extremely useful and is used by many, many people. And, if you have a 401k, for instance, right? Most workplaces, when you have a 401k, right, they may have a match, but you offer up some percentage of your income every single pay period that gets put into that 401k. That gets invested into whatever investment vehicles you have chosen, any mutual funds or things of the like that you have chosen for your 401k to be invested in. And once you make these choices, once you choose, right, you're just pouring money into these things, no matter the price, no matter what the price of that mutual fund is, no matter what the price of that specific investment is, you are putting in a certain amount and continuing to buy regardless of the price. And that's what most people do, right? And people can also do this within their IRAs, right? They just set up a systematic monthly withdrawal from their checking or savings account that goes into an IRA. They can do the same thing with some traditional brokerage, taxable brokerage account. And they can do the exact same thing, right? Just systematically putting money away in similar amounts, no matter what the price is, right? And again, this is a very lucrative way of doing things. Now, some people may also choose the lump sum method, right? They may choose to say, hey, I'm just going to save up all this money and then invest it all at once, and then save up and then invest all at once, right? They're going to take more of a lump sum method. And this can be okay if you come into some windfall of money, right? Typically, if you come into some windfall of money and you are to just put it all into the market regardless of the price all at once in a lump sum manner, then you are likely to make better returns just statistically than if you were to dollar cost average that money in, because you would be making money on your money all the way through, and you wouldn't be missing out on gains with your money sitting on the sideline. And so some people like the lump sum method. But what I want to talk about specifically in today's episode is neither the dollar cost averaging or the lump sum method, but something that can be complementary to each of these methods, and that is buying the dips. And what do I mean when I say buying the dips? I mean when a specific investment or investment vehicle or the market as a whole takes a dive, when it dips, right? When there's a certain amount of dip, then you jump in and you invest. You buy the dips. Now, this is something that seems extremely scary for a lot of people, right? Buying the dips is a scary proposition. Why? Because typically when there are dips, there is panic. And when there's panic, everybody is telling you that things are only going to get worse and things are bad, and that investing is not a good idea and you should put your money in this or that or whatever to save your principal or whatever it may be. But those are exactly the times when investing is the most profitable. Like Warren Buffett has said, and I've quoted it to you many times, be fearful when others are greedy and greedy when others are fearful. So basically saying when the market is real high and everybody's getting real greedy, then that's when you're most likely to have some type of pullback. Or when there's a pullback occurring and everybody's selling, that's when you can likely make some profits because you can buy things at a cheaper price. Well, that's exactly what we want to do when we are quote unquote buying the dips, right? When we are buying the dips, we want to buy things at a cheaper price and be able to profit on them over the long term, right? It's the idea of things falling in price in an irrational way, right? In a way that is more than what they should be falling in price if they were to maintain some potential intrinsic value, some value that that particular company is worth or that particular investment vehicle is worth. They fall below whatever price that may be, and then it is time to buy, right? There's a lot of value to be found in that investment. There's a lot of value to be found in buying those dips. So we're going to talk about why it's important that you do this, regardless of if you're putting money in systematically or doing the lump sum method, that you should still be buying the dips regardless. Now, people who are using the dollar cost average method probably don't care a whole lot about buying dips because their whole ideology is, hey, I'm going to buy it when it's high and I'm going to buy it when it's low, and I'm just going to be able to make money regardless, right? And that's perfectly fine. I subscribe much to the same ideas, and that's perfectly fine for you to do, right? My wife has a 401k that we systematically put money away in. We have IRAs that we systematically put money away in. I understand the idea of dollar cost averaging and not caring. But there are also going to be times, there are going to be opportunities that you can take advantage of where you can choose to purchase something that is on sale, right? You can buy something that is cheap relative to its intrinsic value, and you can make a lot of profit on the back end. I'll give you a perfect example, and it is a very new example, and it can be useful to you, hopefully, and be indicative of what you may choose to do in the future. Last year, 2020, right, when the market fell because of the coronavirus, and it fell violently, it fell over 30%, I knew the history of the market, right? And this is extremely important to buying the dips in a proper manner. You have to know history. You have to know and understand what you're invested in. But I understand the history of the market. I understand what the S&P 500 has done historically, how much it has fallen given certain circumstances and things of the like. The market starts to fall, and it starts to fall in a precipitous way. It falls very aggressively. And it was scary, undoubtedly, because the value of your investments day after day is cratering. And you want to make sure that you can come out ahead in some way. Well, the only way to really come out ahead is to either sell before any of this happens, which means that you are a visionary and you can time the market perfectly, which is dang near impossible, right? Or you wait till things fall enough in value and you purchase them cheap. That way, when they increase in value, you can make money on that increase in value. And so that's what I chose to do. That's what me and my wife chose to do. I knew that if the market had fallen 30% or more, there was either not a lot of space left to go downward, right? Even though the market has fallen as much as 55% in the past, but either there wasn't a lot more room on the downside, or even if there was that 55% drop, things rebound extremely quickly. And if you can get something at a 30% discount, that seems like a pretty good deal. So last year I bought, right? We bought a large amount out of money that was in savings, and we put it into the S&P 500. And since then, that money has made over 60% in returns. And it's because we bought the dips. We bought extremely low. Now, that is a huge example of buying the dips, right? That's a big example. That's the market fell hard. That is you don't get many opportunities like this to buy the dips, but there are more subtle ways to buy the dips as well. But what you need to understand is you can buy the dips on a broader market scale if you just pay attention. If you just pay attention to what the market is running at as far as like the PE ratio, right? We've talked before about the PE ratio being price to earnings, and as it is higher, that means that valuations are higher and that things are trading very expensively. Well, if you can find the market cheaper relative to what it is typically trading at, then you can purchase things at a dip and be able to ride them up towards the higher valuations. And that is a valuable thing to do. Or if you just understand how much the market has fallen in the past and what it should do moving forward, like I was talking about a moment ago, you should be able to do this in an effective way as well. And it absolutely does not matter if you're a dollar cost averager or a lump sum investor. If you see things occurring, especially in the broader market, that you can take advantage of in these ways, why would you not do it? Why would you not decide that if something is extremely profitable and I have money sitting on the sidelines that I can invest, that I can put to work, why would you not put that money to work? Even if you're a dollar cost averager and the market falls 30% and you're still dollar cost averaging, well, let's say you've got a little bit in savings that you're like, hey, I could put this money to work, I could invest this money, and you could do so, and you could do so at some handsome profits into the future. And what buying the dips is going to allow you to do is to have a higher overall rate of return over the long term. If you buy the dips consistently, especially the big dips, and let's say you continue to dollar cost average, then you will make higher returns than the typical dollar cost averager over the long term, because not only did you buy high and buy low and just get the average return over time, you also bought when things plunged, and you can get some of the highest returns when you buy things extremely cheap. And that's the whole idea. That's the whole idea of being able to buy a dip. Now, buying dips is not just for the broader market. It can also be for an individual stock within the market, right? It can be individual stocks that you hold. Now, I've talked about this before, and I want to reiterate because it's been a while since I've told you, not everybody should be trading or investing or whatever in individual stocks. Individual stocks hold a lot of risk that the market as a whole does not hold. And they require a lot of work, a lot of research. And if you don't have the time or the ability to do that type of research, then just buy the market, buy index funds, buy mutual funds, things of the like, and make your money that way. There's no reason to venture out into individual stocks when you don't know anything about them. But if you hold individual stocks, you invest in individual stocks, I want to give you just a few pointers as to how to buy a dip, what it looks like to buy a dip in an individual stock. Obviously, history, again, plays a part. History plays a part in your ability to buy a dip, because knowing the movement of the stock traditionally, knowing that the stock may have a certain level of volatility, or knowing what causes a stock to go down over a particular point in time is extremely useful as well. For instance, right, if there are broader market sell-offs and it is having an extremely negative impact on the specific stock that you own, even if that company has a sustainable business model, even if that company is creating cash flow and growing and doing all of the things that it is supposed to do, right? Even if it's doing all of these things, that doesn't mean that the broader market sell-off is not going to impact that particular stock, especially if that stock is a part of an index or a large part of an index. As that index gets sold off, so will that stock. That stock will be negatively impacted by the volume of trading done in the index. And so let's just take an example like the past month or so, right? In the past month or so, we have seen a broader market sell-off when it's come to tech, right? Because rates have risen a bit, right? It's become a little more expensive to borrow. There's the whole idea of the reopening trade, all of these things that are traditional businesses that require brick and mortar that are likely to reopen soon, or there's a lot of very positive outlooks for those types of companies because of the coronavirus vaccine and things of the like, and reopening the economy at full tilt. And so there's a lot of things that point to those companies doing well, but tech maybe not doing as well as it has done in the past year or so, because it's not going to be relied on as much. So there's this rotation from tech into other parts of the market, from growth into more value type companies. And we've talked before about growth and value investing, right? But there's this rotation that has been occurring. Well, as this rotation has occurred, a lot of companies have fallen in price quite a bit, even though they have not done anything wrong, right? They may not have had an earnings call. They may not have had any type of bad news. They may not have had anything occur other than the broader market risk that is inherent to that particular stock. And so you've seen a lot of companies fall in price quite a bit. There's a couple in particular, one of which has even had a really good earnings call, a really good quarter that was reported that still fell. And so that one would be NVIDIA, right? NVIDIA fell hard even though it had a really good quarter, but it is a part of that semiconductor space, that technology space. And so it fell with the other companies that were similar to it. Apple has even fallen. It was down, more than 15%. And we know that this is the biggest company in the world, a very strong cash flow company, a strong balance sheet company, and very, very hard to get them to lose 15% of their value. So I would argue that they didn't lose 15% of their value, but the market said that they should be corrected by 15%. Who knows if that was too much or too little, but they had quite the pullback. Tesla, right? Tesla has had an even bigger pullback than the other two. Tesla was down over a third, right? They were down like 35%. And they had done nothing wrong. They had done nothing out of the ordinary. There had been no earnings call. There had been nothing crazy that had occurred. And they were down from over $900 a share to under $600 a share. And so these pullbacks do occur. These broader market sell-offs do have impacts on specific stocks. And if you own some of these specific stocks, these may be really good opportunities for you to quote unquote buy the dip, right? This may be a good opportunity for you to buy certain things, but you have to have an idea of what those things are worth. You have to have an idea of how they have traded in the past. You have to understand value. You have to understand what they are really worth, because even if something declines in value by a third in the market, right? Well, they may actually be worth even a third less than that, or even more. So it's important to understand what something is really worth, and then buy something based on the fact that it is trading for less than what it is really worth if you are trying to buy a dip. And so this is something you can do with individual stocks. You should do with individual stocks because it can average your cost down. Now, what is the danger? What is the danger with individual stocks to buying the dip? Well, the danger is if the dip is actually bad news. It's actually a bad thing. It's actually something that should be occurring, right? That's the danger that you have. The danger that you have is when a company goes down in value and they should be going down in value, right? That's the danger, because if you try to buy a dip and the dip continues, right? Or you try to buy the dip and there's actually bad stuff going on that's going to continue to deteriorate the value of that company, or the company is not worth what you once thought it was, and that is going to be dangerous for you to buy that dip, because what you could end up doing is just buying the way down and it just continuing downward. But if you have a good quality company, you agree with what the company's doing long term, you understand that it can grow and it will grow into the future, then you do need to understand that if that stock continues to fall, then it is only going to be advantageous for you to purchase more shares at a cheaper price to average your cost down. Therefore, whatever returns you make will be higher than what they were at the original price at which you purchased whatever it was. Right? And that's another thing. We can try to be good value investors in a lot of cases and buy things for less than we think that they're currently worth, right? But if things continue to go down in value, then we do need to continue to buy if our investing hypothesis continues to hold. If the reason that we bought continues to hold, then we should continue to buy as things go down in value. Therefore, we can make higher returns on the back end. So that is the idea of buying the dip when it comes to individual stocks as well. Now, there are a couple ways that you can really benefit from buying dips, and it's not necessarily the idea of just buying the broader market or buying an individual company, but you can look at a few different things and you can make it really easy on yourself to buy certain dips. So one way that you can look at buying the dip is that you can look at sectors, right? Sectors rotate from time to time. So when I was talking earlier about the technology sector rotating out and maybe rotating into industrials or things that are a bit more permanent, right? Things that are a bit more value oriented in the way that they trade, right? Maybe those types of rotations should lead to you buying the dips in the sectors that are being rotated out of, right? So you can look at different sectors and you can see large year-to-date declines. You can see large declines from their highs and be able to tell if something has some value, if it is trading below what it is actually worth. And you can buy the dips into certain sectors. And you can do this through certain ETFs, right? There are many ETFs that track these sectors of the stock market. I know Vanguard has some. I know that State Street, the Spider, right? Those ETFs, they have some of the sectors. They really have all of the S&P 500 sectors really well broken down, right? And if you see big dips in sectors, then you can just buy the whole sector, right? You can take away some of the danger of buying an individual company within that sector and just buy up the whole sector. And you also, you can maximize some of your returns in doing so instead of buying the broader market. So let's say, the broader market fell because financials fell hard, right? Well, instead of just buying the broader market because the financials fell hard and you can make money in the broader market, you may be able to make more money in buying the financials that have fallen, right? Because it is more specific, it is more narrow of a group, right? You are actually pinpointing exactly what fell and buying that, right? But you're not buying an individual company because there is more risk involved. So you're taking more risk than buying the entire market that fell, but you are not buying individual stocks. It means you're taking less risk than doing that. And so you can buy sectors and you can buy the dips in doing that as well. Well, you can also, you can take a little more risk than that, and you can buy large companies with big drops, right? So there have been some companies that have been able to recover extremely quickly from the coronavirus downturn, right? We know this. Microsoft, Amazon, Johnson & Johnson, right? Their stocks came back extremely quickly, especially some of those tech names and those medical companies like Johnson & Johnson. They've had a lot to do over the past year or so, right? And so for these companies, the dip ended pretty quickly, right? They had a dip because of the broader market and their dip ended pretty quickly. But some blue chip companies that have been stable for years that were hit hard by the global pandemic, their valuations fell really hard and haven't recovered yet. But that's not to say that they will not recover. So you can look for dips in companies like this that have fallen hard and haven't reached back to whatever their valuation was. Again, if the story hasn't changed, if their fundamentals have not changed, if what you value them at is still greater than what they are currently trading for. So buying the dips in those situations can be extremely profitable. And I would say it's something that you should do if you are buying individual stocks. Again, individual stocks are not for everybody. I don't think they should even be for most of you. But if you are buying individual stocks, then buying some of the bigger companies that haven't rebounded into their valuations that they should be at yet, if the market was normal, if the economy was normal, then you can buy some of those. Now, also beware of some of these companies where they may never come back to normal. Things may never go back to the way that they once were, and understand that that can be a hindrance on valuation as well when you're trying to do this. But what I really want to convey to you is that you can buy things cheap. You can buy things on sale. That's why it's always kind of nice to have a little bit of extra cushion in savings around, right? Not just your emergency fund or not just savings that you should already have, but a little something extra. That way, if the market does fall hard, if a company falls hard, whatever, right? You can continue to add money. You can add money and buy the dips. You can buy cheap and then allow your money to compound at higher rates of return into the future. Look, for most of you, you might not do this. For most of you, you might just continue to dollar cost average into the future, not pay attention to the market. Listen, that can make you extremely wealthy. That can make you into the top 1% as far as net worth and as far as being able to retire with dignity in the United States. And so that's perfectly fine. I'm not knocking that. I'm not knocking that is perfectly fine and something that will make you a lot of money over the long term. What I am saying is that if you pay attention to the market, right? If you pay attention and let's say you invest in individual companies, or if you buy certain ETFs or whatever it may be, and you pay attention and you see that things fall hard, investigate why things fall hard. Investigate the history of those things falling as hard as they have. Investigate what is going on. And if you can determine that there's some long-standing value that's still available to be had within those particular investments, then take advantage of that value. Invest in those things. Buy those dips, and you can make some extremely high returns on the back end, right? I'm not telling you that these opportunities are going to come around often, because they don't, right? I'm also not telling you that every dip should be bought. I've told you before, every dip should not be bought, because there are certain dips that have meaning. There are certain dips that have some reasoning behind them. They have an overvaluation behind them, or they have a material change in whatever a company or a sector is doing behind them. So just buying a dip blindly is of no help, right? It's not going to help you to just buy things because they go down in value, but buy things because they go down in value irrationally. Because as a market, we overreact to things, we underreact to things. And if we overreact to bad news, like we did the coronavirus pandemic, as a broad market, then you can take advantage of that. If we overreact to bad news, just like they did in the financial crisis, you can buy things for big returns, right? And there have been other corrections over time that you could have easily taken advantage of. 10% corrections in the market tend to be good buying opportunities. Anything over 10% is always a good place where you can put a little extra money into work. But the bigger the drop, especially in the broader market, the bigger the drop, the more value you can get on the other side. With individual companies, the bigger the drop, the more wary you need to be. But if you can still determine that the value has not changed, what they are worth and what they will be worth in the future has not changed, then you can still be extremely profitable. The bigger the drop, the more profit you can make. But especially with individual companies, the more wary you should be of why those specific companies fell in price so much. So the bottom line is, learn to buy the dips. You can make higher returns. You can make a lot of profit on your money over the long term if you will just learn that things do fall in price. And not only buy the dips, but don't jump out on the dips, right? Don't jump out when things go down. That's when we have the opportunity to buy. That's when we have the ability to put some money to work and make good long-term returns. And I am preaching to you that you should absolutely be attempting to do so if you are investing, right? If you're in this part of the financial action plan and you can do this, then absolutely put more money to work when things fall, especially the broader market, and you will not be sorry. Just do your due diligence, understand why things fall, and buy the dips carefully. But you should not be sorry if you buy high quality things at low prices. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below if you haven't done so already, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, then be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you create a financial plan that's specific to you and your family's needs and keep you accountable to that plan over the long term, then I can help you do that. Just go to my website, www.MNOwithDylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as I talk about the decision to invest or pay off debt, and why I believe what I believe about the particular subject, and why it may not be perfectly in line with mathematics. And that will help many of you who question whether you should be investing or paying off debt at your current point in your financial plan. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.